Live. How to get rich in the second half of 22 after a bloodbath to start the year. This is one of the worst years for stocks and bonds. The only hedge that really worked was being long energy, which our clients did, and it's kept us above water. Here's how we recommend investing $10,000 today. It's about the exact opposite of how we were looking at the markets just about 9 months ago when we were very long energy. So for every $10,000 being invested today, here's what we're recommending to new clients and existing clients. Step one, look at the defensive side of the portfolio. In general, we're seeing a big slowdown in the global economy, and this is due to interest rates rising so rapidly this year. It's grinding everything to a halt as central banks globally are hiking interest rates at this exact same time. So step one is buy 86 shares of UVXY. This went up over 1,000% in the March 20 crash. It's not gone up a whole lot this year because we haven't had a huge limit down series of down days. We've had just extreme volatility up and down as the market slowly grinded lower this year. So right now that's coming in at 11.5% of the portfolio. But again, we're only interested in the number of shares. The percentage will go up and down every day. So for every $10,000 following the program, pick up 86 shares of UVXY. That's your stock crash insurance. Step two, this is going to be a beautiful multi-year hold as interest rates are going to be forced back towards zero to allow governments to grow debt this decade. And make no mistake, they will manipulate the markets to achieve this as soon as they can get inflation under control. So we're long the ticker TMF. That's the 30-year treasuries. And again, we're not trying to collect the 3.5% interest rate these play. What we're really interested in is betting that the interest rates will fall. We can double, triple, and quadruple our money in TMF. And it's got to be one of the safest long-term bets you could possibly put money behind. Outside of the NASDAQ, the only asset that's really had extreme high win rate for decades are the US Treasury market. Critical part of any portfolio. It's been in a 2-year bear market. Load up 183 shares of TMF. On the offensive side, assuming we don't have a complete meltdown in financial markets and inflation's about to cool off, we got a critical CPI print Wednesday and producer price index on Thursday, and then Michigan sentiment on Friday with some earnings cracking out this week as well. Assuming the economy is as strong as I think it is and inflation's about to slow down, we're most likely going to see a massive bull market in the offensive side of the portfolio, which is 269 shares of Grayscale Trust, ETHE. This is down 70% year to date, and it's trading at a 30% discount for its par value. So if they do manage to convert to an ETF, and they're suing the SEC over this right now, you're basically buying Ethereum 30% off when you buy ETHE. So this is coming in at 21% of the portfolio. Now with notable companies like Netflix down 70%, Amazon down 30%, there's just a massive screaming buying opportunity to go long the big giant tech companies with leverage. Assuming peak interest rates are in, we're likely at the bottom of the NASDAQ sell-off this year. So FNGU gives you 12 mega cap tech companies, 2 of which come out of China and have been in a bear market for over a year. And those are Baidu and Alibaba. So right now that's 10% of the portfolio, beautiful buy opportunity, FNGU. It's about half our exposure to Ethereum, and it's trading at 129 shares at $8.18 a share, representing 10% of the portfolio. Now, as long as Putin's going to keep marching and NATO's going to keep sending money over there, we're going to keep the cost of oil and natural gas artificially higher than it should be. We're already seeing a crash in all the food commodities, wheat, corn, soybean, everything is falling fast. Metals are crashing. But because of these sanctions on Russia and also the US administration in charge keeps blocking refineries and drilling, they're keeping the cost of oil and natural gas artificially high. So until the war comes to an end, we want to hedge against inflation and energy costs being a big problem for markets by being long NRGU and oil. Now, we made a lot of money betting on the run up to the war and into the war with those plays. We sold, we patiently waited for a big fat crash and we got it. And now we're back in. So hang on to your horses. There's no end in sight of this war. I actually think that we will see Ukraine most likely surrender within the next 90 days or less, as Russia is now sending something like 2,000 tons of artillery shells per day, while Ukraine's only able to return 1/10 of that, and they are in retreat mode. Meanwhile, we have chaos spreading through Europe. We have farmers blockading all of the transportation, and shelves are empty. Boris Johnson's gotten kicked out of the UK. So everything's tumbling down politically if you were pro-war, because it's creating massive inflation and energy costs. So my bet is that we're going to be selling NRGU and oil for a big profit, and then rotating that into ETHE, FNGU, and TMF, and wait for the big deflation play to play out. So that's the way we're looking at markets. Let's break this down play by play. Step one, buy 86 shares of UVXY. This is your deflation crash insurance. Here's the chart in March when you got the real capitulation, the big panic. And what happened was this puppy went up 1,000%, while the S&P 500 fell 25% in a single month. We're not expecting that this year, but if it happens, you're completely protected with your crash insurance. Now, the Fed hiking cycle typically has ended with deleveraging events, but what's critical is that this takes years to transpire. We've literally had one rate hike, and we're looking at what will be the next one. It's most likely going to be either 50 or 75 basis points, and I think that's already pretty much priced into the market. After that, expect the Fed to pivot into midterms, and for this to be very bullish in markets. Now, what this chart doesn't show you is how many times the Fed's pivoted and saved the market. It's only showing you the times where they overdid it and ended up crashing markets. So if they do go overboard and crash the entire global stock market ahead of midterms this winter, well, we'll be prepared by owning treasuries and UVXY. And this chart just gives you a feel for how bad recovery times can be in stocks and why we do want to have a highly diversified portfolio. So we're looking at the Great Depression with Roosevelt running the show most of that period. And then we're looking at the 70s inflation. I don't see either of those repeating. Okay, we really have some self-inflicted problems in the financial markets due to warmongering and this whole notion of climate change, which I think is going to be politically voted out of office this coming election cycle. So we should see energy costs come down and perhaps enter a Goldilocks period for markets here is what I'm anticipating. Again, we can go into greater detail, but we're just not seeing the economy of the 70s, where we had massive labor growth and internal manufacturing to drive inflation for a decade. And we're also not living in the Great Depression era, where we didn't know how to print money out of thin air. So most likely, we're either at a bottom or very close to the bottom in markets today. Step two, buy 183 shares of TMF. This is the ultimate bet that the global economy is going to slow down until they want to start running these new spending packages that cost trillions of printed money. The economy is going to go from an inflationary fire to a deflationary fire. So you want to be betting on tech stocks essentially and bonds. It's really that simple. So load up with 183 shares of TMF, and that's going to give you 3 times the amount of bonds you would get if you're just buying the TLT. So a beautiful way to get extra power behind that play. Here's a chart of TMF here. And so it's absolutely, without question, going to new highs. If you understand how the global economy works, it's critical. And if you listen to what these IMF bankers are up to, they're trying to figure out how to drive interest rates to negative territory because it's the only way they're going to be able to keep the show running. Otherwise, they're all going to get voted out of office because they won't be able to make good on all the promises they've made to the citizens. And so it's essentially about making these digital currencies that they can distribute to the entire population, bypass the financial system. And they want to start putting time limits and restrictions on what you can use with this free money. And this is to essentially drive interest rates lower and control the economy in a much more detailed manner. So we're seeing this roll out in China, and they are writing lots of papers to roll it out in Europe and the US. So look for TMF to break to new highs over the next 2 to 4 years, going from 1260, probably well above 50 in this next bull cycle. Okay, so Wednesday we get the core inflation and the headline inflation. The economists have been so wrong, it's almost dreadful to even tell you what they think is going to happen. In general, I believe the core inflation rate will drop to 5.8, and that the headline is going to remain sticky due to these energy costs. Next month, I actually think the headline and core will be falling pretty precipitously because oil is now trading in the 100 to 110 range, which is far below the peak in March at around 130. So the rate of change in the monthly comparison on energy is actually going down, even though it's at this very expensive level from here. So as long as we don't blow up the oil and natural gas sector by sanctioning, they would now have to go sanction India and China, who are buying up all the Russian products. And they'd probably have to ignite some more stimulus into the economy and somehow drive rates lower. Essentially, I see extremely low risk that inflation won't be falling for the rest of the year, and allow the Fed to pivot, which can be very critical for markets. There's another look at that TLT, which is just a unleveraged version of TMF. Long-term, look at the trend. We can have these crashes in interest rates, which means TLT is falling, but the immediate reaction is it rocket ships higher. The high interest rates are poison for the global economy, and politicians and central banks globally know that this cannot be withstood. So almost certainly we're at a bottom in the TLT and want to go long. There's only a few bond markets that are still going up, and so it's some oddball bonds, which we'll point out here. The 3-month is rising while the long end's falling. So we're actually looking at an inverted yield curve. Huge signal to buy tech companies. It's really when the yield curve steepens that we'd actually get worried about a stock crash and recession. So the 3-month is rising while the rest of the curve is falling today. Here's that 2-year. This is really what dictates what the Fed's doing. It's been falling. If we zoom in a little bit, you can see it's been falling for several weeks now. So the bond market's basically saying, all right, you're going to hike a few more times and then you're going to start cutting into next year. So expect the Fed to do 50 or 75 this month, slow it down dramatically next month, pause, and then most likely start cutting interest rates into next year. Again, this would be very bullish for markets, and it's critical to keep the US government funded. They cannot recycle $32 trillion of debt at 3% interest rates. Not going to happen. 10-year, you can see, has been falling for several weeks. Over in Europe, the spread between the German and Italian long bond is causing all sorts of chaos. And so essentially, they're using German debt that's maturing to pay off Italian debt. What a mess. But this is where there's been a lot of pain in bond markets, and that's starting to resolve itself once again. So the inflation's coming down. Here's that German bond, which has been famous for going negative on its shorter duration, also falling. So pretty much every bond market globally is falling. There's only one exception that's important, and that would be the Japanese long bond. Now they're doing yield curve control on the front end of their bond market, and there's been massive billions of dollars, hundreds of billions of dollars trying to short their currency and bond market simultaneously. And so if the global bond markets start to recover and inflation does start to fall, look for an epic short squeeze on both the Japanese bond market and currency market. And they're betting as a government about $100 billion a month right now to protect the line because they know the global economy is falling fast, and this is going to make these yields go back down. This is going to be extremely bullish for risk assets once that short squeeze comes up. So there's very few bond markets that are not in the process of recovering. And even the long 30-year Japanese bond is at least trading flat while there's massive, massive shorting happening. Another bond that's been pretty darn stubborn, and we'll get a lot more bullish once it finally starts to make a good run for the upside, is the junk bond market. So it has also stabilized. It's at a critical level and probably one of the last few to really worry about. The investment grade bond markets recovered a little bit faster than the high yield, as you can see here, and also way below trend line. The core PCE price index starting to fall, Fed's favorite metric. If we use PMIs to predict inflation, every PMI is falling globally, and this typically leads the US by about 6 months. So we got Germany actually going into a trade deficit, which is taking Europe's currency down. We've got Italy's PMI falling, Poland, Australia, South Korea, China, all of them. If we look at these commodities, cocoa, cotton, orange juice, coffee, lumber, sugar, all crashing down. Used car index, which was driving the CPI all year, crashing. So container shipping rates falling fast. The bond market doesn't believe the Fed anymore. The dot plots are way higher than what the bond market's predicting into the future. So they're just doing a bunch of hot talk here to try to cool off the inflation before they pivot. That's essentially what we're expecting here. Soybeans falling off a cliff, wheat falling off a cliff, corn falling off a cliff. So it's really, and especially Dr. Copper has been having one of its worst falls in quite some time. But China's about to start turning the heat back up, printing money, and so we're not expecting some sort of big giant crash here. There's another chart of wheat, lumber futures, the Baltic Dry Index measuring the cost to ship commodities between continents, down from a high of 5,000 to 2,000. So the only sticky thing really is the high yield bond market, the Japanese long bond, the US 3-month, and then the darn price of oil and gas, which is being, again, artificially kept higher in the US by policies put through Biden blocking production, and then more importantly, NATO's sanctions on Russia, which are being worked around, and that's why we're seeing oil fall. So in general, we're expecting to really not make a lot of changes and see some really nice gains with this current portfolio construction. Starting to see the housing market cool off. We've got 15% of housing deals canceled last month. The Austin market, which was red hot, has massive people selling all at once. So the deflation's coming in strong and fast. Step 3, pick up 269 shares of ETHE. This is the ultimate growth product. I look at it as a product that can rip off the entire US financial system, from brokerage houses to insurance houses to loan origination. But it's also simultaneously ripping off what Microsoft does to be able to design applications to do anything you can dream of. So the market cap for Ethereum is massive. And after a 70% sell-off on ETHE this year, it's one of the worst in its entire history. This is typically a great time to buy the dip. We're very bullish on cryptocurrencies, especially Ethereum this decade. I do think you'll see Ethereum break 10,000 in the next 4 years or less. So coming in at 1134, buy the dip. And what we like even better than Ethereum are the applications that have been highly successful on the Ethereum platform. So you can learn more about that as a paid member by looking into our private equity offering called Rebel Dividends. You'll have to call Dean once you're a member to learn more about that. But if you want an extremely aggressive cryptocurrency play, that's how you can get even better exposure than ETHE. If we look at Bitcoin's 200-week moving average, it's only gone below it 4 times in history. It double bounced in 2015. This is when China's real estate market was crashing, and it caused China to go into a mega print mode as the US was tightening from 2016 to 2018. That's funny. That's exactly what's happening today. China has bank runs across the country due to real estate sector imploding, and they're going to have to start printing trillions of dollars to bail out their economy and get the social unrest. The worst nightmare for a communist dictatorship is having hundreds of millions of people riot because they can't control that many people. So we're really coming up on the exact same setup from 2016 to 2018 that drove Bitcoin to one of its best returns in history. Bitcoin RSI is at a new all-time low, signaling to buy. And we had the worst quarter ever and the worst month ever. So this is usually the best time to buy the dip. This is looking at cycles and the halvings in the Bitcoin process. Essentially, it's predicting we're going to top out to a new high around 2024, 2025, which also happens to line up perfectly when I think we're going to see interest rates bottom out in the bond market. There's that quarter 56% loss. Buy the dip. Now, why do we like crypto in general, especially Bitcoin, which of course is the main way that Ethereum would grow? It's the increasing debt, and the trend is globally that the debt's growing at an exponential pace. And this is because we continue to make more promises than we can deliver upon with a deteriorating economy. So the government reacts to this not by making things more efficient and productive, but rather by doing the opposite, by printing money to keep the voters happy. And so what took 215 years to create 7 trillion in debt was now reached in a measly 2 years. Can you believe it? So that's the trend, and it's not going to stop. That's why you want to own these assets. Now, DXY is going to fall as soon as all this chaos slows down. And the chaos is going to slow down as soon as central banks believe the inflation fire has been put out. I believe we are either there or a month away from being there. And that's when you see DXY fall, and you're going to see the euro and the yen get a bounce. Both of these plays are extremely overdone, and that's when you're likely going to see Bitcoin explode higher. In the cycle from 2017 to 2018, DXY fell 10 points to give that massive, massive return in Bitcoin. Now we're starting at 108 today. This chart says 107, but we hit 108 today. So the move higher in crypto is going to be parabolic when that falls. Here's a look at DXY over history. And so you can see last time we had it at this level was the .com burst. Go back to the 80s for an even higher print. It's not going to last. This makes it almost impossible for trillions of dollars of debt denominated in dollars in foreign countries to be able to afford their debt payments. So old Janet Yellen's doing this on purpose to get that CPI to fall. But the second it starts to fall, watch for everything to pivot, for that dollar to fall, the euro and the yen to bounce, and then stocks and cryptocurrencies are going to absolutely love it. Here's the Japanese yen, which has devalued about 20% year to date. And this is because they're printing $100 billion a month to protect their bond market. But once again, we are weeks, months away from a big reversal in the perception of inflation, which is going to create an epic short squeeze on the yen and the euro, which is now trading at parity with the dollar. Okay, so if rates are going lower, we want to own tech stocks. We like FNGU. It's 12 gigantic tech companies with 3 times leverage. It's a hand-picked basket that gets the most call options. So when people go nuts buying call options on specific stocks like Tesla or Facebook or Google or Amazon or Netflix, it forces the dealer who is writing the option to hedge their bet by buying the underlying stock. And that's why FNGU in a bull market just spanks the triple Q. I mean, it outperforms it 3 to 1. And that's because of the fact that retail and big whales are not buying call options on indexes. They're going straight to the best companies in the world that have the best track record of growth, and they're buying massive amounts of out-of-the-money call options. The broker dealers who write those options hedge it by buying the underlying stock. And it creates these ridiculous melt-ups, and why a handful of companies are dominating the returns in the NASDAQ. So we love FNGU over the triple Q. Here it is. Give it some time. If you wait a decade, I guarantee you it will be at new highs. Probably this cycle, which we're thinking is going to be about 2 to 4 years for interest rates to bottom out. Beautiful time to get the blood on the streets. Buy FNGU. A couple companies, not going to go through all of them. Amazon, you can see it's at this massive sell-off. Amazon's not going anywhere. The diesel fuel is killing their profits. But again, we're expecting energy costs to come down. because the political willpower to keep all this nonsense going on is going to disappear. Any sort of policy to keep energy costs high will be eliminated after these midterms. In Europe, everybody in power is getting booted out. People are outraged. So most likely Amazon's going to do just fine over the course of time. Same thing for Apple, big sell off to buy the dip. You can see it's starting to bottom out here. Same thing for Tesla. It's really the same thing for all these giants. Now, Alibaba, maybe my favorite, down for not just 6 months, down for 18 months. This is due to China doing all sorts of crazy regulations to try to create better prosperity for the whole population. Not going so well. They'll probably go back to their old plan here soon. Tech stocks are also not irrationally priced when we look at some of the other bubbles in history, because these tech giants print money like nobody's business. They're not just making bets on future returns. Now, when the market does hit a bottom in various recessions, you're not necessarily over the recession when the market bottoms. The forward-looking return is outrageous. We're looking at an average return of 43% over 12 months once you hit the market trough. So are we absolutely at the bottom? Maybe, maybe not. But 12 months from now, we're certainly looking at a very high probability of an excellent return by buying and holding these assets. If we look at the forward multiple earnings, you can see there's easily the risk of one leg lower. But we're going to look at the data. It just doesn't support that. We've got a very strong economy. It's slowing down, but we're still hitting new record highs on just about every aspect. In the NASDAQ, insiders haven't been perfect, but they've been pretty darn good about predicting market bottoms. And they are aggressively buying their stocks up right now as we speak. And they've planned out nearly $1 trillion of buybacks this coming year. Here's a look at your S&P 500. Here's a look at the NASDAQ. Here's a look at emerging markets here, which is having lots of problems due to the food and energy crisis. Here's a look at the European market. So big sell-off in all of them, but nothing's fallen off a cliff to absolutely freak out here. Now, again, if we're going to predict a recession, almost without exception, you've had a steepening of the yield curve, which would mean this line is going up, not down. If it's going down, that means the bond market saying the Fed needs to cool off and that they will stop raising interest rates and lower them. It's when the front end falls and the long end rises that you get those recessionary periods. It's just not happening. We got the long end falling while the front end rises. So we're more likely to have another inversion of the yield curve in the near term. Here's that chart long term over several decades. Again, if it's going up, that means your short-term interest rates are falling while long-term interest rates are rising. And it's a healthy indicator, and it eventually leads to a recession as you peak out the economy. Not happening, just not happening at all. We're headed towards an inversion, if anything. We had a strong payroll print again last week, so a lot of people are anticipating we may see a 75 basis point rate hike. I believe it'll be either 50 or 75, and they're going to start to slow down. The PPI and CPI Wednesday, Thursday are going to be important, so we'll have better analysis for you on that next week. If the CPI is too hot, I might do a trade alert for customers. If you're on a free trial, this is your last day of the free trial, so you'll have to upgrade before Wednesday if you want the reaction trade alert to what's coming out on the CPI. Bank credit continues to grow, consumer credit continues to grow, retail sales, while slowing down, is at just epic levels. We're just hitting epic consumer spending. We're still importing lots of goods as the dollar becomes strong, makes our purchasing power even greater. New housing sales still coming in red hot despite these rising interest rates. China's PMI is jumping right back up to 55. Their imports and exports are going back up to levels we've never seen in history. So to think we have this massive depression coming in, I believe, is incorrect right now. Step 5, buy 5 shares of NRGU. That's your inflationary war play. Again, Russia is doing very well. And they have no plans to stop. So until Ukraine surrenders, and it's questionable if they'll stop at Ukraine. So we will see. There's about 5 countries they want to take over to really secure their resources and make it hard for an invasion. And if you study Peter Zahan's End of the World book, Russia's been invaded 72 times over the last several hundred years. So they really want to fortify their resources and protect the rich beds of oil and natural gas. That's what this war is really all about. And so right now, there's really no good news for Ukraine. It's just been a slow but steady retreat from the south side of the country. They have cut them off the sea. They've cut off 75% of their GDP, and they are just plowing away with about 2,000 to 4,000 tons of artillery shell per day. So lots of Ukrainian losses without even actually going to battle. So we'll see how long the NATO and Putin wants to keep this up. As we get more close to winter, much more leverage for Putin. So I anticipate there's a high probability of negotiation beginning well before winter. And now in Russia, that's really going to begin in late December. So we still got quite a while before it gets super cold. Here's NRGU at 258. Buy the dip. If oil is above 100, these companies are printing money like nobody's business, and oil is likely going to stay above 100 unless the Fed just goes insane with rate hikes, which I don't anticipate. So unless the war ends, we want to be long NRGU if oil is above 100, and we're at this pricing level. So again, I do anticipate NRGU and oil will be the first positions we sell, assuming the Fed doesn't screw things up sooner. Here's a look at oil. Went to 99 for a split second, back up today, but at 104. It can stay at this level for a while. It won't for long. Most likely it'll come back down to that $70 range long term. So we got to be careful with this trade. It's really the war hedge. Here's a look at oil falling, but bouncing back up. It's sticky. One of the big plays in NRGU is Exxon. So we can look at it. It's at historically high levels. But it could go higher. You keep oil at 100, Exxon's printing money like nobody's business. And again, with the federal government blocking all the new production, gives them a monopoly here. And once again, we are seeing in general the cost of oil cooling off despite the sanctions, because India and China are buying it and then reselling it to Europe. It's comical. So the only way they could really fix these sanctions would be to start problems with China and India. So if that happens, we will be prepared. Here's commodities hitting this trend line by the dip. Again, job openings are at record high. It's cooling off a little bit, but it's still at extreme levels. So we're still seeing a really good economy here and strong labor growth, which is again going to give the Fed that courage to keep hiking here, at least this month, most likely. Quits still coming in heavy. So strong economy. We're not betting on basically a huge crash in energy right now, and that's why we're long. Buy 32 shares of Boyle. This is a really dangerous play. The US government is risking shutting down half our production because it's not up to climate change rules currently, which would be disastrous for Europe. They're already spending 10 times the cost. It's very, very complex to get natural gas from the US to Europe. We have to freeze it and put on these super high-tech ships. And now we're facing a bunch of hurricanes in the ocean. So there's a risk for this to go down for if the government shuts down all the production or if the war ends. On the other hand, if the war keeps marching on and they allow the production and shipment of natural gas to Europe, we could see this LNG, we could see Boyle go back to new highs quite quickly the longer the war goes on. And that's why this is part of the high risk portfolio and not the safe growth. And here's Boyle at 40 after trading at as high as 130. So we let go of it at 115 and patiently waited to jump right back in because there's no end in this war. Here's a look at energy costs in Germany. They're now rationing hot water. They're putting limits on how hot you can heat up your house. So this is highly unpopular, obviously. The cost of Electricity has gone from 50 to 300 euros per megawatt. People are pissed off. And this is crushing the German manufacturing sector. So the pressure to end this and get energy costs is extremely high. Now, Germany, which wanted to have a clean economy, is now racketing up coal plants to keep the lights on. Here's some of the farmers protesting. So it's all just crumbling on their hands. A little funny note from Jeffrey Gunlack, one of my favorite investors. Dear Mr. President, please admit excessive stimulus and lockdowns were significant drivers of inflation and pledge you will not support either of these policies again. Sincerely, Jeffrey Gunlack. And the good news is stimulus is dead. Manchin has made sure of that, and the lockdowns are over. So we want to bet that we're going to go from an inflationary environment to a deflationary environment, which again means you want to be long bonds and tech and get the hell out of those energy plays the second the war ends. Now I have some new charts that I wanted to pull up that were not in the presentation last week. This is the University of Michigan Consumer Confidence. And you can see when it gets to these levels, typically is the low in these markets. So we got a new one coming out Friday, but this is a good signal to buy the dip. DXY at this level is disastrous for earnings. This is probably one of the more bearish charts I could show you that could argue for further downside risks. So we need the Fed to pivot and energy costs to go down and the inflation to fall to create this massive reversal in the DXY versus the euro and the yen. And I think we're very close to that moment in time. So not freaking out about it at this point. Here's a look at the expected drawdown in central banks' balance sheets. And it's almost laughable. If you look at the last 2 decades of the central bank's balance sheets, show me any moment in time where they're able to sell off almost any of their bonds. It doesn't happen. And now they're projecting they're going to drop $6 trillion worth of debt into the market. Yeah, right. Give me a break. So I think we're going to see a massive pivot here before any of this ever transpires. The growth of debt is really going to be the key theme of our lifetime because it's happening faster and faster and faster. Okay, delivery times relative to PMI, everything is cooling off. Austin housing market has this massive amount of houses for sale. It was averaging 600, jumped to 2,000. Everybody's rushing for the exits. We're seeing this huge cool off. Aggressive action. Here's banks that have hiked by 75 basis points. We did it in the last 2 meetings combined, 25 and 50. Most of the world has hiked really quickly. So here's the inflation in Europe. This is why you have protests and chaos. You have political disorder. You have people just completely outraged. And it's not going to last for long. They have to deal with this. The dollar index, it can go up to these levels, but it quickly reverts. We're looking for the reversion. Essentially, we're saying it's too late to bet on the downside in general. We've already seen the pain. Now we're likely to see the reversion. This chart's looking at bear markets, and if we are heading into a multi-year bear market and the economy is about to crush, which again, we don't have any data to support that, then it could be worse. That's why we own treasuries and UVXY to protect against that. They would both go up if this bear market were to continue. This is looking at the duration of a flat or bear market for Bitcoin. Longest has been 624 days. A lot of them have been less than half a year at 180. And this current bear market's at 481 days. So we got to be getting close to the end of this pullback here. World central bank liquidity flows. We can see this sharp crash, but what happens right after the crash? You get a sharp reversion. So we're probably pretty darn close to central banks pivoting here because they're causing so much pain in markets. This is looking at hedge fund positioning being short. So we got a record short, and that typically turns into a short squeeze. So really what you need for a massive short squeeze is a decent low CPI print Wednesday and PPI Thursday. That'll do the trick. And then get a dovish Fed response either this month or next. And that's going to cause massive short squeeze in all sorts of markets. This is comparing the US gas futures to European. And you can see we're trading at 25 while they're up at 175. So the pain for Europeans is just immense. That's why we're seeing Boris Johnson getting kicked out of here because he was so pro-war. The car index has fallen even further from the last chart we showed you. This is just some remarkable commentary on crypto. So the sell-off was brutal, but big picture, is this bullish or bearish? Here's what this fellow Ryan Siki says. 2013, critical marketplace goes under, founder arrested, spoils auction. 2014, critical exchange goes under, 700 million lost to theft. 2022, $40 billion token wipeout with Luna, $20 billion stablecoin failure, $20 billion fund failure. That's that Three Arrows Capital. The founders are now running. They don't know where they are. Multi-unicorn insolvency with Voyager, BlockFi, and Celsius. Celsius paid off that loan now. So a lot of the pain is already behind us. Most of those companies are now wiped out. We're shrugging off unfathomably big losses and fuck-ups this year with no systemic threat, no bailouts. Blocks keep clearing. Builders keep building. Bad bets get punished, and otherwise the metronome keeps ticking on. Just a look at the disaster unfolding for everybody pushing for these policies that's creating this inflation right now. Macron loses majority in France. Johnson resigns in the UK. Draghi under extreme pressure in Italy. Rutte facing farmer uprising in the Netherlands. Trudeau embroiled in scandals. Biden imploding in the US. The globalist leadership is taking it on the chin. US job openings minus unemployed still at very high level, indicating this economy is still going to keep growing the labor force. And that maybe is actually the scariest thing for the Fed to not understand we're coming into a slowdown if they hike too quickly. Okay, very good. So that's going to go ahead and be the end of the free presentation. We're going to jump into the paid only content here. And if you're on YouTube, you better call Dean. There's 3 spots available. And again, we're doing potentially a trade alert if that CPI is too hot. If it's not too hot, this portfolio is going to skyrocket. But if that CPI is too hot, we might get some more volatility in markets. So call Dean now at 505-322-7515 to upgrade your free trial. Okay, I'm going to go ahead and end this version and go into